At this point in time, what do you sort of peg the odds of recession at? Like I said in the intro, some people think it's almost, baked in the cake at this point. Are you that confident?
Yeah, and I think I go back to what the markets are saying, and by markets I mean fixed income, treasury market, euro dollar futures, interest rate swaps, some of the more deeper fundamental stuff that the monetary system itself telling us what's going on. And you look at the yield curve inversion since March, that's not a good sign. Eurodollar futures have been inverted since December, and they've only gotten more and more twisted and distorted to lately. The Eurodollar futures curve in particular is just unbelievably, incredibly ugly, which is saying that if we interpret the Eurodollar futures signal, what it's saying is that there is a very, very high probability the Fed rate hikes end before the end of this year. So what would it take to stop the Fed before the end of 2022 to get it out of its hawkish, utterly ultra hawkish inflation fighting mode to say we're done hiking rates, and maybe if the Eurodollar futures curve is right, and it has been right historically, to start cutting rates. So how do we get Jay Powell from wannabe Paul Volcker 1994 75 basis points at a time to stopping rate hikes and maybe starting to cut them all over the next 6 months? What does the economy and financial markets look like under that kind of a scenario? And I think the answer is the market is discounting heavily the fact that it's not just a recession, but it might be a kind of a nasty one. And that's how we get the Fed out of its inflation fighting and into rate cutting like it wants to be. And that's how we account for all the way the markets are pricing these probabilities, not just now, but through time, where as events have happened, as everything has unfolded, they've become more and more and more convinced that this is the scenario that's going to play out, not less and less convinced, or any opportunity along the way for a deviation, for the economy to move in another direction, for the monetary system to actually contain itself. Through time, it's only been, the markets are more and more convinced. Nothing is ever 100%, nothing is ever inevitable, but the way these curves are priced now, I baked into it. Yeah, I think our baseline best case here is a shallow recession. And I think the markets are starting to contemplate something more serious than even that.
You, from your point of view, say that the Fed is making a policy mistake here in terms of continuing to tighten into a problem that is solving itself?
Well, I think that the Fed was correct last year when they said it was transitory. And I think they actually believe that. And they would have been correct if they had believed that, because they at least understand the basic economics at work here. And I think what changed earlier this year was the politics. Now, I know the Fed's independent, all that crap. No. The Fed was given a lot of political pressure, put under a lot of political pressure, because let's face it, that's the number one issue that voters are focused on this year is consumer prices.
Yeah.
Although right now it's consumer prices plus recession, but by and large, the politics of the situation has changed, and you saw the Fed's rhetoric change, and they've had to try to come up with a way to make themselves relevant to this political discussion, because how on earth are rate hikes going to get more oil out of the ground or get containers from the West Coast to China? They're not. This is all pretense. This is all pretend. This is all done for political show and political theater. So I think deep down, the Fed knows that rate hikes are not going to solve anything, but at least it allows the government to say, well, we've got the Fed. It's the most aggressive, and it's the Fed. You don't fight the Fed. It's the central bank. Everybody relies on it. And so it's in terms of politics, the Fed is raising rates, but I think at some level they understand. In fact, I know they understand, because you look at some of the models that they put out, like the FRB and WISE model, for example, the DSGE model for the US economy, which shows that in all likelihood, according to this Fed model, by the time we get to the end of next year, GDP will be lower than it was at the end of last year. So the Fed models understand that something bad is going on here, and it's probably not going to be because of rate hikes, it's because of supply shock factors. And it's really the Fed, as far as making a policy error, is more about a political error than anything.
All right, so let's assume for a second here that the administration's calling the shots and saying, all right, Fed, politically, we need you to do this. If that's true, it sounds like they are setting themselves up for perhaps an even bigger, they're making a trade-off for an even worse outcome, right? Where it's like, look, and I get it, look, high inflation, that is a stone cold election killer, right? So you're petrified of that if you're an incumbent. But by forcing the Fed to tighten here, very quickly, you might end up with too much of the opposite, which is, oh my God, we've now created a massive punishing recession, and that's a stole code election killer either.
That's even worse.
Yeah.
Who was it said that asked the question, what polls worse, inflation or recession? What if the answer is both?
Yeah, I mean, and the sad thing is, I think we're going to find out the answer to that question pretty soon.
And I think that's why the market has priced what it is, because the market realizes that the political pressure to raise rates quickly becomes the political pressure to unwind them very quickly if we get into a nasty recession scenario. So, when you look at the way the markets are positioned, the way things are actually taking shape, it makes a lot of sense here, and it doesn't make sense in terms of money printing. And I would add one other thing here that nobody is talking about, because nobody ever talks about this, even though it is the biggest monetary factor and the biggest monetary danger, and has been over the last intervening decades. If you go back to 2007 and 2008, if you asked me what was, to use a single word to describe the 2008 crisis, I would say collateral. It wasn't about subprime mortgages. It was a collateral shortfall, a collateral shortage that became essentially a repo run that essentially devastated the entire global system and global marketplace. And we've never fixed that. We've never solved that. One of the reasons why is because everybody thinks bank reserves are money. Everybody thinks the Fed printed a lot of money. Therefore, why would we worry about liquidity risks anymore? When in fact, the collateral system has been increasingly worse shape through time. March of 2020 is a perfect example of what happens when you don't have enough collateral. The Fed didn't save anything. The Treasury Department did more than the Fed. But essentially, we have a collateral problem. And some of the collateral indications that we've seen over the last several months are alarming.
Okay, and sorry to interrupt, but can you just define really what you mean by collateral?
Collateral is financial assets that are used to secure essentially funding transactions of various nature. This is where the Eurodollar system really gets its more complicated features. A simple repurchase agreement or repo transaction sounds simple. You have cash, Adam. I have a financial security. You want to lend that cash as safe as you possibly can. So you say, well, you give me the rights to your financial security. And if you default, I get to sell your security. I get to be made whole. So I'm essentially posting a financial security for the cash that I'm borrowing from you. But as we find out in practice, it's not so simple as that, because most of the times I'm going to post a security to you that I don't even own. It's owned by somebody else that's been reused and repledged a million times over. And so it's not, repurchase agreements aren't always cash for collateral. There are many that are collateral for collateral. For example, I might be a hedge fund. I want to invest in junk bonds because I think they offer the best returns in this environment. But I also want to fund these junk bonds as cheaply as I can. So I'll contact a dealer and say, I want to go into the repo market to fund these junk bonds that I want to own. But if I go into the repo market with these junk bonds, they're going to give me a huge haircut, which means I have to put up a lot of my own money to buy them. I don't want to do that. I want to borrow a US Treasury from you so that I can take that US Treasury into the repo market and get the best possible terms. I get a low rate, get a low haircut. I can have the most leverage possible. So I'm borrowing a Treasury from a dealer that I then pledge into the repo market to borrow the cash that I can then use for junk bonds. And then the junk bonds I buy, I'm going to use as collateral for the collateral that I borrowed from the dealer. But as it turns out, the dealer, that the Treasury I got from the dealer isn't really the dealer's either. They've got it from somebody else. So we have these multiple collateral legs that get really complicated, really screwed up. They cross boundaries. There's lots of junk. There's lots of not junk. There's lots of these collateral for collateral transactions. Long story short, when we started to get into these periods where these junk collateral that's sort of at the end of these collateral chains becomes reevaluated for various reasons, like subprime mortgages in 2006 and 2007. That's what really happened, was that it kicked off a collateral implosion because of reevaluating the valuations and haircuts in some of the repo transactions. And in 2022, we have a global economy that's really sick. It's really not doing well, that is never recovered from 2020. And now the markets start to reevaluate some of that junk collateral. What ends up happening is, as the hedge fund, I've put up junk collateral for US Treasury so I can go into repo. Now the dealer says, I don't like your junk either. I need to change the haircut, or you need to put in some of your own money. Otherwise, I'm not going to let you borrow this Treasury anymore. And if I can't borrow the treasury, I can't fund my portfolio in repo, which means I got to fire sale my assets. So it becomes a real big problem when these collateral chains start to implode on each other. And we see this happen in any number of ways, including something like repo fails, which is where collateral becomes so valuable that in a repo transaction, I lent you cash, I got your security. I say, you keep the cash, I want the security. So repo fails happen. That's a sign of collateral strain. T-bill prices, which are absolutely astronomical, especially at the front end, the 4-week bill, which is yielding next to nothing, way below RRP, which tells you there's a huge collateral premium in the marketplace. There's a number of indications that tell us over the last several months, the collateral chains have been starting to implode, which will have enormous, if it continues, it can have enormous deflationary monetary consequences, which I have to believe is one of the things that's motivating Eurodollar futures or Treasury curve to be so pessimistic as it is, because when you have a simple supply shock recession, pair that with the deflationary monetary possibilities in the collateral breakdown situation, you go from Jay Powell ultra hawkish to Jay Powell ultra dovish in a flash.
If you enjoyed this clip, you can watch the full video it's from by clicking here.